So we're continuing our program, and we're going to talk a little bit more about payments in Web3. So the topic is how Web3 payments will go mainstream, because they will go mainstream. We're going to know how they're going to go mainstream. And for that, I'm going to call up Nick Charteris from Crypto.com and Nikola Plecas, head of crypto product at Visa.
Where am I going? Here?
Yeah. Hello. Welcome.
Hello.
Great. So how you guys doing? All
Yeah,
good?
not bad, thanks.
All right.
Very well.
So we're going to talk payments. So this is kick it off and ask you guys how you would define sunglasses?
Yeah, maybe. Yeah, it's pretty bright.
How would you define Web3 payments, like the general kind of definition, and maybe follow up on that into why would a business go after adopting a Web3 payment?
Okay, so I think if we look at evolution and we say Web 1 was really just a read-only experience, and Web 2 was more about content creation, and Web 3 is now about ownership, self-creation, monetization, owning your own identity. And that's the sort of environment that we then sit in. From our side, we've tried to create a sort of digital financial ecosystem that allows you to make payments, trade, access financial services, all in one space.
Got it. What's your definition of that?
Yeah, I would like to add to that and just say that to always get funds in and out, it's useful to use some of the existing infrastructure, including payment networks such as ours. So I would extend the definition and also add that you need to have ability to on-ramp and off-ramp successfully into new kind of payment systems, and which is where kind of existing networks can come in and help.
Yeah.
Got it. And in terms of comparing traditional payment rails and the new crypto payments, how would you kind of compare these two? Because I know there's a lot of talk about throughput, transactions per second, or latency, how long it takes to actually settle the transaction, and obviously those come into play when we think about customer experience specifically. So how would you compare, say, traditional and Web3 payments? And what criteria would you use to compare these two separate infrastructures?
It's a great question. So I'd probably like to break it down into experience from kind of consumer perspective, and then also think about what's required to run these transactions as well. From a consumer perspective, in Web3, you still have a lot of people who see crypto primarily as an investment asset, as a savings technology. So maybe they don't necessarily want to use it as money. If we go beyond that, some of the existing kind of experiences are not that great. So you need to be crypto native to really understand how to use the existing applications to make money transfers or payments. And then on the other side, as a consumer, this is a one-time push-off transaction typically on a blockchain infrastructure, and you don't necessarily have consumer protection or ability to say chargebacks. So from a consumer angle, it's kind of limited and hard to use today, and there are no incentives to kind of help you switch, right? Typically, there are on existing kind of, say, car programs, you have a lot of rewards, incentives, which kind of try to keep you within the program, but with wallets, it's very limited activity to date. On the merchant side as well, you also need to have the ability to safely and securely hold these assets. You need to invest into new capability to take custody. Beyond that, from a merchant perspective, you need to have a regulatory overlay to really govern how would you classify these assets on your balance sheet, but then also have the ability to manage both your treasury operations, right? So that whatever you can do today with fiat money, it needs to be either better or more secure, so that it entices you to actually hold these assets on the balance sheet. But secondly, you need to be able to use them to pay your workers, suppliers, etc. And for that, you need to have some form of certainty that you would know what the value of the assets will be when you need to make the payments. And below all of that, I would say there needs to be a regulatory overlay, which would really help build some trust from all the participants in the ecosystem, like what we have today with existing kind of fiat networks.
Got it. Do you have any angle on that? Sorry.
Is that you or me?
It's probably me. Sorry for that.
No, absolutely. And thank you for that. I literally want to hug you for what you've just said. So I would say, as a sort of lead-in, digital commerce is pretty widely accepted. Just about everyone's got there now. That's fine. But the next stage of being able to accept crypto as from something that is really something you buy and hold to something you use for everyday payments. You need obviously trust in the security of that transaction, and that's a major part, and trust in the security of the platform. So we've built Crypto.com Pay, and that has a merchant side and a consumer side. So for the consumer, that allows you, one of our 50 million customers allows you to pay for goods and services with crypto. So that's that side of the problem. And out there are loads of people, they want to be able to pay for goods and services with crypto. On the other side, we have the merchant platform that allows merchants to accept crypto for goods and services. So that's a full suite that a merchant might accept, for everything from being able to integrate to their checkout to being to have a platform to manage that money in whatever format that it is paid in, and the ability to invoice and integrate into their financial management systems. As Nikola said, there's a really interesting point, which is quite a lot of people, or quite a lot of merchants out there are not comfortable holding crypto on their balance sheets. So of course you have to have a mechanism for them to settle out in fiat currency as well. And as we're seeing increased adoption there, people are becoming more and more comfortable. So perhaps a merchant will start out by saying, yes, I want to accept crypto because I have customers that want to pay in it. That is a very simple equation. But then they'll say, I'm not happy to hold it, please can I have that settled in fiat currency? And say yes. And as they get more and more comfortable with it, they're more happy to hold in stable coins, perhaps Bitcoin, less so perhaps in some of the more exotic currencies.
Okay. And I think you guys kind of alluded to that, but in the perceptions of the merchants specifically, we're kind of a central point in the payments process. What are the kind of core challenges that they need to overcome to actually go and start using Web3 payments as kind of a part of their operations?
Are you starting that?
I don't mind, you can start.
So I think, the whole, for them to adopt it, they've got to accept that they've got to be able to accept the sort of the risk levels that are there, which means that the regulatory environment's got to engender the trust that they need. They've got to understand that the platform they're using confers to the same security standards that their own risk management protocols require them to have. They need to know that there's adequate protections in there, and they need to be able to manage those revenue flows. So I think probably we're seeing an inflection point, whereas this was very nascent earlier on in the year. We're now seeing more and more e-commerce players want to be able to accept crypto alongside traditional payments, and it's really a matter of choice. Maybe 5% of their consumer base want to accept crypto. As a merchant, that's great. I want to accept crypto, and therefore I need a platform that I can do it with, that I trust.
Got it.
Yeah, I would build on that and say that on the regulatory front, as a merchant, you need to have certainty of how you would classify these assets in your balance sheet. And depending where you look in Europe and globally, there's a very various classifications, right? So it's, if you have kind of multinational operations and you're probably reporting in several countries, suddenly things are getting very complex. If you want to accept, say, a stable coin or Bitcoin in one of your countries that you're operating in. Secondly, I would say that for you as a merchant to hold these assets in your balance sheet, you need to have a monetary interest to do so. So whatever you are beyond the security element, which is incredibly important, you need to be able to generate at par or higher return that you are with existing kind of fiat assets, so be able to convert them into fiat immediately and then put them in kind of the existing products that you're using today. And then finally, you kind of have to see the interest from the consumers to enable this as well, because you're enabling a payment method that has very few takers on the other side. As a merchant, typically, depending on your size, this can be quite substantial or quite important in your say, dev hours, etc. So you need to make some tactical decisions.
Yeah.
So kind of the business model and the numbers have to match.
You guys both touched into one of the aspects which probably are more of the imperatives in this point in our crypto economy history, which is regulators, right? You both alluded to the role that the regulators could play in enabling all of that and enabling the going mainstream with Web3 payments. So is there any particular aspect of regulators and regulations that are going to be more, promoting more of that adoption or restricting more of that adoption, and what those would be?
So I'll start, shall I?
Yep. Go for it.
So, I mean, from our perspective, we're super keen on regulation, and we work with regulators all over the world at the moment, and it's fairly obvious we put a lot of effort into getting over their hurdles and getting registered or regulated, depending on the various things. But I think, you know, again, it all breaks down into trust. And trust is based on the accountability of centralized platforms such as ourselves within the economic environment that we operate in, and consumer protection. So, for example, at the moment, we're registered as a crypto asset provider with the FCA. On one hand, they supervise us with the fifth money laundering directive. On the other hand, they kind of expect us to do a full lift as a regulated entity without all of their mandates there in place. And so they need to get to that, and we need to perform to that, and then that will engender trust, and that allows us to, as a crypto firm, to work with the tier one financial institutions and so forth, and become, you know, even more part of the ecosystem.
Got it.
Yeah, I would take a slightly more macro perspective here from regulatory angle. And the first thing is really you need to provide the overlay to kind of classify these assets. Once you kind of have the ability to classify them, it can really engender adoption and ability for you to transact with them or to be able to accept them as a merchant. Beyond that, I would say that you also need to find a way to regulate some of the crypto financial instruments, so that if you say a merchant and you're holding stable coins and you want to put them in a kind of overnight protocol of sorts, those need to be regulated. Those need to be allowed from you as a merchant to put funds in the same way that you can allow to put funds in today in particular kind of savings products from existing financial institutions. So those forces, and also potentially clarifying the roadmap of how you, as a regulator, will maybe work with regulators and other constituencies to cover use cases that have a cross-border element in it, can also help kind of existing firms in the space to plan out and also enhance their own product development that can help me as a consumer or kind of you as a business have a better experience.
So if the regulators play the part, they could be a massive fostering force in adopting Web3 payments more broadly, but they could also play a part of restricting that if, you know, they don't position. And we're seeing, as you mentioned, Nick, we're seeing across the globe different stances in regulation. Some countries are like, okay, I'll let retail because I can't stop retail, but institutions are not going to go there. So, and if you're preventing institutions from adopting, then you're preventing crypto payments to ever take place in the market, and then you prevent all that innovation from happening. And if payments are not happening, then the other more sophisticated crypto things can't happen either, because you don't have the access to the underlying asset. So, and I know we all like, you know, good regulation and it's smart regulation, so we're hoping that is probably, we're going to see more of that as well. Under that light, one of the core components of payments is having, and you also both mentioned that, is having a payment mechanism that is recognizable and recognized by regulation, by merchants and by consumers. And we're seeing, and I think the number right now is that CBDCs are being explored by 90% of the countries or central banks in these countries. And we're also seeing a lot of maturity coming in from the stablecoin side of things. We had Matt Hancock here yesterday, alluding to the UK stablecoin, which is, from an authority is an interesting perspective to hear. And we're also seeing that there is a chance that some stablecoin issuers are applying for banking charter licenses, which is also an interesting movement towards more clarity and level playing field in this space. So, in your perspective, I'll start with you, Nick. In your perspective, what is the trade-off between, say, CBDCs and stablecoins in the context of Web3 payments, and is there any implications of going one way or another in a sense of creating this possibility of going mainstream?
Crikey. Well, I think the first thing is that you've got to be very clear about the difference between, if I go back a stage, probably wouldn't have CBDCs without stablecoins, or we wouldn't have stablecoins without crypto. And so it's very, very important to categorize the difference in stablecoins that exist between those that are fully collateralized and those that are not. And I think, as we look at, from our perspective, when we look at taking on different types of coins, we have a very, very robust due diligence, the tokenomics, liquidity, the local regulation, that sort of stuff, and before we'll take them onto our platform. And I think the same needs to be applied for CBDCs. They need the same governance, they seem the same criteria to make sure that they are robust, but also I think that they can all exist alongside each other in the same way that cash and digital currencies or digital payments exist alongside each other. All of these will continue to
incrementally.
Incrementally, and I think it would be naive to suggest that one would overtake the others potentially, but they will find their balance together.
Yeah, I mean, just for clarity, CBDCs, central bank digital currencies, they can come in various flavors. We're seeing discussions on the wholesale side, which is more used on the banks or financial institutions versus the central bank. There's the retail, which is an aspiration so that individuals could touch the central bank digital currency. There are the MCBDCs that are multiple variants. There's the cross-border one. So there's still a lot of types that are being explored. That's why 90% of central banks are exploring CBDCs. Some countries have rushed in front and are issuing that already. And you're right. Stablecoins also come in different flavors and forms. And when we talk about stablecoins, we're hopefully talking about the fully or over-collateralized ones, which are there's more stable than the others, I would say. So back to you, Nikola. In terms of the bridging that widespread adoption for Web3 payments, how do you see the role of CBDCs and stablecoin actually enabling that?
I would like to echo Nick's words here, and I think both will play an important role, depending on the constituencies, and there are big regional differences in, say, how Europe is approaching it versus US versus some markets in Asia or Africa. There'll be big differences, and they'll play different roles, but they will coexist together. On the CBDC front, you're absolutely right. There is the wholesale and the retail use case. They're looking to address different pain points that exist today. There's also a lot of design choices on CBDC. Doesn't necessarily have to run on DLT rails. You can also limit how much an individual can hold. Does it need to be a citizen or a resident of a country to be able to hold CBDC? Where can they use it, etc.? There are less limitations on the stablecoin side today. They're more kind of built on open standards, so any of us can use them like Lego building blocks to build new applications. I don't have that capacity or knowledge, but maybe you guys do. And it's kind of, as they evolve, I think we'll probably have additional regulation, which may differ across geographies, which will kind of clarify what are the use cases for both, or what areas either can play in, say, countries in Europe versus US versus Latin America versus Asia.
Got it. So you mentioned the building blocks, et cetera, and one of the things that is new when a merchant is entering the world of crypto payments, and I think you kind of brushed through that, and I want to just explore a little bit more of that, is what are the new risks that this new format of payments would require the merchants to actually consider? Because it's fine. We know that if we're talking about crypto assets, we're largely talking about more volatile assets as well. But because they're also very technologically different, there might be some other not surfacing risks. So how do you sort of how would you educate or inform a merchant that's willing to start using crypto payments to actually go and understand the risks that he's now subject to?
Yes, it's a great question. I would probably start by explaining what are the different options that you have to custody these assets, and depending on whether you want to go with a existing centralized institution like say Crypto.com, or you want to go with a non-custodial or maybe even a hardware mode, there are different risks and trade-offs, and it really depends on your ability and willingness to take risk as a business. Beyond that, you also need to, as a merchant, be aware of what you can do with these assets and what you cannot do with these assets, whether they're, excuse me, cryptocurrencies or stable coins or maybe CBDCs in the future. And then finally, kind of, what advantages will you have from accepting these assets in the terms of, if you don't, what is the risk of losing out on 10, 20, 30% of retail populace who are using these assets to make payments on a daily basis?
Got it. What's your take on the risk side?
Well, certainly I think it's an education curve that needs to take place. There are still quite a lot of, still plenty of retailers there adopting different online payment methods already. Quite often their checkouts are already congested, as I'm sure you're well aware, with multiple different payment types, including buy now, pay later options have just bloomed all over the place. Okay. But Nikola's quite right. Not only have they got to figure out whether or not they can accept this and hold it on their balance sheet and how they're going to manage that, they're going to need to wonder about what the cost is of integrating and the cost of transactions. And in effect, this is new technology, and so that the cost per transaction can be driven right down. But I think there is a comfort level that retailers will need, or e-commerce platforms need to get to understand how quickly am I going to be settled with, how soon am I going to receive my money, am I going to be exposed to market fluctuations? And I think that's why we settle with them in stable coins, so that they can make that choice, and why we and the ability to then do a sort of secondary settlement in a fiat currency is something that's been driven by them this year. But I think the drivers are very clear for some e-commerce platforms and retailers. They have customers who are crypto native, who are excited about crypto, and they want to pay and they want to buy whatever it is they want to buy in crypto. And as a merchant, you need to make that available to them.
Got it. So we have a couple of questions from the audience, and I'm going to ask and see if we can cater to them. So the first one is, given the restrictions that can be applied as CBDCs by a sovereign nation, how are they aligned with the ideals of crypto? How dark and dangerous is this? How dark and dangerous is this path? I'm gonna give it a shot, right? So, as Nikola mentioned, not every CBDC is the same. Not every one of them will be built on crypto rails. So there are other forms of blockchains or decentralized ledger technologies that are being used that don't necessarily go into the same infrastructure we're seeing Ether, Bitcoin, and other forms of cryptocurrency. So I would assume that this 90% of the central banks that are exploring are also exploring in the terms of technology. So they're trying different flavors. So every type of CBDC is probably going to run into a more adequate technological infrastructure. So I would not look to them as they're all being the same. But if they are, let's give this an exercise. So if they are, how aligned are they with the crypto ethos? And is it a dark and dangerous path, as the question alludes to? What do you think, Nick?
I think, as I said earlier, that CBDCs stable coins, cryptocurrency, and the crypto ecosystem will and can all exist side by side. There's quite a long, it's still a pretty nascent stage to make some claim, I think, about where we're going to end up. But generally, we're very keen to see nations introduce CBDCs with the proper regulation, governance, so forth. I think, as long as those parts are in place, then we should welcome that. How dark and dangerous is this path?
That's a great question.
It's a great question. I think there's a couple of things. So obviously, centralized platforms such as ourselves, being regulated and supervised allows a large segment of the market to be trusted. But equally, everything on the blockchain can be tracked. We see Chainalysis doing a phenomenal job. They said last year that 0.15% of transactions were deemed fraudulent. That's considerably lower than we might see in some traditional financial spaces. But I think that forms a very interesting opportunity for regulators and those looking at the risk side, is that they can now see and analyze transactions en masse. They're not having to go to two different large financial institutions and say, can we talk about this individual transaction? They can see it in real time and see where it ends up. And that gives a lot of power. And as people get their heads around that, will engender a lot of trust as well, I think.
So in terms of darkness and also the dark and dangerous, I think darkness and light will coexist.
It always does.
Yeah. So we're all Jedis now. So I think that's another question to you, Nikola. How does Visa manage the tension between the threat to your core business of new payment rails going mainstream and the opportunity it provides? So that's actually a great question as well. So how are you guys balancing this new world of opportunity with obviously the pre-existing business that is core to what you do?
I would say that the kind of blockchain rails come neatly into our network and networks thesis, such that we want to be able to use our network and also speak and work together with other networks that are coming in parallel. So those represent kind of net new opportunities and flows for us, and we really are trying to act as a bridge between existing kind of financial ecosystem businesses and exciting new propositions kind of being built out in the crypto space. So really, I wouldn't classify it as a threat. I would classify it as an opportunity. And also, like new networks, it's not the payments, not a zero-sum game. New networks can add resilience to the existing networks. They can solve for kind of net new use cases, which are hard to solve with the traditional or like established rails, let's call them like that. And kind of finally, they also bring a lot of opportunity for Visa to kind of build out and look into new areas of development.
And ultimately, it could be also a better margin play, right? Because it's like a public infrastructure that you pay by transaction. You probably can, release some of the capital that's locked into a heavier infrastructure that you're calling. I'm asking to break out your balance sheet. That's not what I'm asking. I'm saying in the perspective of using a public permissionless infrastructure, it's a much lighter burden on your balance sheet in terms of the assets you need to carry to actually perform all of that processing as well. So we're about done with time. There's a few more questions, and I mean, if you guys are going to be around, they can be asked. But that's it. Thank you so much for the insights. Great conversation.
Yeah, whoever that Guerra was, I'm very happy to take that.
Guerra? Obviously.
Yeah, very happy to talk you through what we've done there.
Awesome.
Afterwards.
All right. Thank you.
Oh, thank you so much.
Thank you.
Thanks. Thanks.